When choosing which private equity funds to add to a client's portfolio, what measures of performance do advisors typically use? The most common performance metrics for private equity are multiple on invested capital, or MOIC, and internal rate of return, or IRR. For example, let's say an investor invests $250,000 in a private equity fund and receives $500,000 back in 1 year. Then that investor would have doubled their money or received a 2x MOIC and 100% IRR. However, if the investor invests $250,000 and receives $500,000 2 years later, then the investor will still have doubled their money or received a 2x MOIC, but the IRR would now be 41%. This is because IRR is affected by time. In the case of MOIC, a return of 2 times sounds lucrative, but the question is, how long did it take to achieve a 2x MOIC? 2 years? 5 years? 10 years? In the case of IRR, its calculation can be impacted by the use of credit facilities. Let's say that private equity fund A wants to invest in a tech company that needs $100 million in funding. At the time of the investment, the manager uses the credit facility loan to invest $100 million. 1 year later, the fund collects or calls $100 million from different investors to pay back the credit facility. By year 2, the fund sells the investment for $200 million. In this scenario, the IRR from the time of initial investment equates to 41%. However, investors experience a 100% IRR based on the time of their initial capital call. MOIC and IRR are both important quantitative metrics when evaluating private equity investments. Our manager selection process goes beyond performance and also considers qualitative factors such as a firm's risk management process, its personnel, and institutional service providers, among other things. Our manager selection process is conflict-free as we are not compensated by any of the managers on our platform. Sign up today to view the institutional private equity funds available for your clients' portfolios.